In the world of finance, an invisible war is being waged every single day. It's a conflict fought not with soldiers and tanks, but with algorithms and capital. The battlefield is the market itself, and the unsuspecting casualties are millions of retail traders. Who's like you? You might think you're making calculated decisions based on charts and news. But what if I told you that you're merely a pawn in a much larger, more sophisticated game? A game where the rules are written by the very players you're competing against. This isn't about conspiracy theories. It's about understanding the cold, hard mechanics of a system designed to transfer wealth from the many to the few. Welcome to the hidden architecture of the market. To truly grasp what's happening, you have to look beyond the price charts on your screen. The market isn't a level playing field. It's a complex, multi-layered structure deliberately obscured from public view. At the very top, you have the market makers, the large banks, and the high-frequency trading firms. They are the architects. They don't just participate in the market. They create Italiano. They see the entire order book, every buy order, every sell order, and most importantly, every stop loss you've placed. Imagine a vast, intricate network of data flowing in real time. A web of information that only they have complete access to. While you see a simple line on a chart, they see a map of liquidity, a blueprint of collective fear and greed. This is the domain of smart money. They aren't smarter in the way you might think. They simply have more information and the capital to act on it. They operate from a position of near omniscience, observing the herd of retail traders, predicting their moves, and engineering scenarios to their advantage. This entire structure is designed for one primary purpose: to harvest liquidity. And your account is part of that harvest. Now, let's dissect the traps, the specific mechanisms they use to ensnare you. The first and most common is the false breakout. You see a stock or a currency pair pushing past a key resistance level. Every textbook you've read tells you to buy the breakout. It looks like the start of a powerful new trend. So you jump in, full of confidence. But just as quickly as it broke out, the price reverses, crashing back down and leaving you trapped in a losing position. This wasn't a random market fluctuation. It was an engineered move. The institutional players pushed the price just high enough to trigger the wave of breakout buyers, creating the liquidity they needed to sell their own large positions at a higher price. They sold to you, and now you're left holding the bag. Then there's the infamous stop-loss hunt. You diligently set a stop-loss to protect your capital, just as you're taught. But have you ever noticed how the price seems to wick down, hit your stop-loss perfectly, and then immediately reverse in the direction you originally predicted? It's infuriating, and it's not a coincidence. Remember, they can see where the clusters of stop losses are located. These areas represent pools of guaranteed sell orders. When they need to buy a large position without driving the price up, they will deliberately push the price down into these zones. This triggers a cascade of stop loss orders, providing them with a flood of sellers at a discounted price. They absorb all your sell orders, accumulate their position, and then allow the price to resume its upward trajectory. You were right about the direction, but they used your own risk management against you to get a better entry. It's a brutal, yet brilliant, maneuver. Another deceptive tactic is the momentum shift illusion. The market is screaming upwards, creating a powerful sense of FOMO, the fear of missing out. Everyone seems to be making money, and you feel compelled to join in before it's too late. You buy near the top, caught up in the euphoria, and that's precisely when the smart money begins to distribute their positions. They slowly and quietly sell into the buying frenzy created by the retail herd. The momentum you saw was the final gasp of the trend, manufactured to attract a last batch of uninformed buyers. Once their selling is complete, they pull their support, and the price collapses. You're left wondering what went wrong, blaming your own bad timing, when in reality, you were the exit liquidity for the institutions. These aren't isolated incidents. They are repeatable, scalable strategies built into the very fabric of market dynamics. But the manipulation isn't just technical, it's deeply psychological. This is where the war is truly won or lost. The institutional players are masters of psychological warfare. They understand human emotion better than any trading guru. They know how to cultivate fear and how to stoke the fires of greed. When the market is in a state of panic, with prices plummeting and news headlines screaming doom, that is when they are accumulating. They create the environment of maximum fear to make you sell your assets at the lowest possible price. They want you to capitulate, to give up in despair. Your panic is their opportunity. They are the calm in the storm, buying from your fear-driven selling. Conversely, when the market is euphoric, and it feels like prices can only go up forever, that is when they are distributing. They feed the narrative of endless growth, encouraging you to leverage up and take on more risk. They create an illusion of control, making you believe you've finally figured it out. This greed and overconfidence make you blind to the underlying risks. You become their perfect exit strategy. They aren't just trading against your chart patterns. They are trading against your emotional state. They weaponize your hope, your fear, your greed, and your need to be right. They play you like an instrument, knowing exactly which strings to pluck to get the desired reaction from the retail crowd. So, what can you do? Are you doomed to be prey forever? No. The first step to winning this war is to acknowledge that it exists. You must stop viewing the market as a random, benevolent entity. Start thinking like the predator, not the prey. This means learning to identify their footprints. Where are they accumulating? Where are they distributing? Instead of chasing breakouts, learn to spot the manufactured liquidity grabs. Instead of placing your stop loss in the obvious, crowded places, learn to hide it or use mental stops based on market structure. Most importantly, you must achieve mastery over your own psychology. Detach your emotions from your trading decisions. When you feel extreme fear, ask yourself, who is benefiting from this panic? When you feel intense greed, ask yourself, am I being set up as someone's exit liquidity? This knowledge is your armor. By understanding the architecture of deception and the psychological games at play, you can begin to turn the tables. You can learn to swim with the sharks instead of being eaten by them. It requires a radical shift in perspective from a participant to an observer, from a speculator to a strategist. The journey is difficult, and it requires discipline and constant learning, but it is the only way to survive and ultimately thrive in this invisible war. Don't be another casualty. Arm yourself with knowledge, control your emotions, and learn to see the market for what it truly is. The game is rigged, but you can still learn how to win. Thanks for watching, and be sure to subscribe for more insights into the hidden world of financial markets. Stay sharp out there. Have you ever felt it? That unseen hand in the market, pushing prices against you, stopping you out just before a major reversal. You're not imagining it. You're feeling the presence of the giants, the institutions that treat the market not as a field of opportunity, but as a hunting ground. And retail traders, we are the prey. But what if I told you there's a way to see them coming? A way to turn their hunt to your advantage. Stay with me, because today we're pulling back the curtain on the market's darkest secret. Welcome to the world of the profit extraction machine. It's a sophisticated system, engineered to systematically drain capital from the uninformed. It starts subtly with the spread, that tiny gap between the buy and sell price. For you, it's a few cents. For them, multiplied by millions of trades a second, it's a river of gold. But that's just the entry fee. The real trap is sprung with slippage. You place a market order, expecting a certain price, but in that millisecond, the price mysteriously shifts, always against you. It's not bad luck. It's a calculated mechanism. Your broker, who you trust to execute your trade, is often part of this machine. Through a practice called payment for order flow, they sell your orders to high-frequency trading firms. These firms see your intention before it ever hits the open market. They can step in front of your trade, buy the shares you want, and sell them back to you at a higher price, all within the blink of an eye. You see a filled order. They see a successful hunt. This isn't a conspiracy theory. It's the documented architecture of modern markets. Your stop-loss orders, they aren't a secret. They are visible data points on a map, showing the institutions exactly where the pools of liquidity, the pockets of retail panic are located. They know where to push the price to trigger a cascade of selling, allowing them to scoop up assets at a discount. It's a brutal, efficient, and almost invisible machine, but nothing is truly invisible if you know what to look for. The giants, for all their power, leave footprints. You just need to learn how to read the signs, the invisible signals they broadcast. The first and most powerful signal is volume. Not just high volume, but anomalous volume. Imagine a stock that normally trades 100,000 shares a day, suddenly trading 5 million shares in an hour, with little to no price change. What does that tell you? It tells you a massive exchange is happening under the surface. A large institution is accumulating or distributing a position, carefully absorbing all the buy or sell orders from retail traders to avoid moving the price. This is a quiet declaration of intent. When you see a huge volume spike at a key support or a resistance level, pay attention. It's often the giants making their stand. Next, you must learn to read the tape. The time and sales window isn't just a frantic scroll of numbers. It's the market's heartbeat. Most retail orders are small. Odd lots, 50 shares here, 100 shares there. But when you start seeing a rapid-fire succession of large, uniform block trades, say, thousands of 500-share orders hitting the tape at the exact same price, you are witnessing an institutional algorithm at work. They break down their massive orders into smaller chunks to hide their activity. But the pattern is unmistakable to a trained eye. It's a whisper in the noise, a signal that a big player is active. And then there's the murkiest corner of the market, the dark pools. These are private exchanges, hidden from the public view, where institutions trade enormous blocks of shares directly with each other. Why? To avoid causing panic or alerting the market to their intentions. While the trades themselves are hidden in real time, they must be reported shortly after they occur. These are the dark pool prints you see on your data feed. A single print for millions of shares, executed at a single price, is the equivalent of a flare in the night sky. It tells you exactly where a massive position was established. If a stock has been trending down and you suddenly see a huge dark pool by print near a bottom, it's a powerful sign that the smart money believes the selling is over. They are quietly loading up before the rest of the market catches on. By combining these signals, volume anomalies, tape reading, and dark pool prints, you stop trading blind. You start seeing the shadows move. You begin to understand the real story being told behind the price chart. Seeing the giants is one thing. Surviving them is another. You cannot fight them head on. A rowboat cannot sink a battleship, but you can navigate the waters they churn. You can use their wake to propel you. To do this, you need a survival protocol. Here are the 5 essential rules. Rule number 1. Never place your stop loss at obvious levels. The most common advice is to place your stop just below a support level or just above a resistance level. This is a trap. Institutions know this. They hunt these levels specifically to trigger stop cascades. Instead, give your trade more room to breathe. Or better yet, use mental stops and watch the price action yourself. If the level breaks with massive volume, you can exit manually. Don't leave a breadcrumb trail leading directly to your capital. Rule number 2. Trade with the volume, not against it. When you spot a volume anomaly indicating institutional accumulation, don't try to short it. When you see massive distribution at a top, don't try to catch the falling knife. The goal is not to be a hero. It's to be profitable. Align yourself with the overwhelming force. Ride their wave. Don't try to swim against the current. It's the path of least resistance and highest probability. Rule number 3. Size your positions for survival. The biggest mistake retail traders make is betting the farm on 1 or 2 trades. This makes you emotionally vulnerable and an easy target. Institutions can afford to be wrong. They can hold losing positions. You can not. Use small position sizes, especially when you're just starting to read these signals. Your primary job is not to make $1 million overnight. It's to stay in the game long enough to learn how to win. Capital preservation is the foundation of any successful trading career. Rule number 4. Be patient. Institutional campaigns of accumulation or distribution can take days, weeks, or even months. They are not in a hurry. You shouldn't be either. Wait for confirmation. Don't jump in at the first sign of high volume. Wait for the price to react. Wait for it to confirm the direction the institutions are pushing. Patience is your greatest armor. It protects you from impulsive decisions and allows you to enter the market when the odds are stacked in your favor. Rushing in is a classic retail trait, and it's a fatal one. And finally, rule number 5. Think in probabilities, not certainties. Even with all this knowledge, there are no guarantees in the market. A giant can change its mind. An unexpected news event can derail the best laid plans. Your job is not to predict the future with 100% accuracy. Your job is to find situations where the probability of success is high, and then manage your risk accordingly. When you're right, you win big. When you're wrong, you lose small. That is the only sustainable formula for long-term survival and success in this predatory environment. The market is not a fair playing field. It was never designed to be. It is an arena, and you have been thrown into it. But you are not helpless. The knowledge you've gained today is your shield and your sword. You no longer have to be the unsuspecting victim of the profit extraction machine. You can now see the shadows, read the signals, and understand the game being played on a level most retail traders will never comprehend. This isn't just about making money. It's about reclaiming your power in a system designed to take it from you. It's about moving from prey to predator, or at the very least, learning to coexist with the giants by understanding their behavior. Use this knowledge wisely. Watch the volume. Read the tape. Follow the big money. Protect your capital, and you will not just survive. You will thrive. Thank you for joining me on this journey into the market's shadow world. If you found this information valuable, consider subscribing for more insights. Trade smart, stay safe, and I'll see you in the next one.